Hello and namaste. This is Neeraj here. Welcome back to my channel, Financial Market Analysis Twist by Neeraj Shah. So in today's video, I would like to talk that how the Indian stock market, or what you call, the Sensex Nifty, is doomed, or what's it? I mean, doomed is a very strong word, but it's going to remain in a weak zone or in the declining phase for quite some time. And also, what RBI needs to do regarding the inflation and interest rates. So, before starting this video, I would just like to tell you, please watch this video till the end so that all aspects will be covered. And if you just see part video and then you take your own, so that will be a miscommunication. So watch till the end, and also if you like, then you please put a like so that it encourages me, and also share it with your maximum friends so that everybody gets benefit. And also I have a separate professional format, in the sense that if anybody wants personalized investment advice regarding any stock or the sector or business consultancy, it is all on a very nominal chargeable basis, and you can contact me by sending me email. My email details are in the description box down below. So let's start. So why I am saying that RBI is kind of a doom, the stock market, Indian stock market, Nifty 50 or Sensex, in a way is kind of, in a very uncertain zone with negative or the downward bias. It's because the first thing, let's study the two aspects. The first is that, as you know, that inflation has zoomed off like anything, which we were kept on saying from November. If you look at all my videos, past videos from November also, I had told that RBI will be caught napping, and inflation will, because I don't know which world they live in, because as we can see that crude oil prices is go up, all the commodities prices are going up because of the supply logistics issue, even worse than what was in COVID, because of so-called another wave of COVID in China. We don't know whether it is COVID or something else they are preparing for, and then the unexpected, this Ukraine and Russia conflict. And this is a long-term effects. It's not going to be solved in next 2-3 months also. So it's last 3 months it is going on, this conflict, and this is the full world is changing. The structural changes, what we call in any for the country's economic reforms or the political reforms. So that is where it's structural changes. The structural changes are having a long-term effect, and it takes also changes over a long-term period of time. It's called structural changes. It's not the cosmetic changes. It takes time, because you are trying to change the base of everything, and for the long-term good future of any particular thing is it's called structural changes. So this is what also happening all over the world, and in India is also no bar from that. So if, as inflation has gone beyond the comfort zone of RBI, which they had told that we will be comfortable within 2 to 6% of the inflation range, and it has gone much beyond 6%. On the top side is a 7.79% as of the latest inflation figure for April, which has come for CPI. So if an unexpected, and means sudden, because of that they got up from the sleep, RBI, and increased that repo rate by 40 bips, so 0.4%, what you call. So on one hand you have a very high inflation, and RBI was lagging into addressing this issue by increasing the repo rates or the increasing CRR, cash reserve ratio. So they will be forced to, where all the other central banks of the world, all the developed banks and also the developing countries' central banks have increased the interest rates in last 6 months very significantly, in a fast-paced increase, and RBI is only lagging. So they will have no other option but to increase the rates. So on the one hand, if they increase the rates, then you will see that at least the inflation of the rupee, it gives a support. But because of the increased inflation, because of the increased interest rates, if RBI increases, then you will see that corporate profits go down because the interest cost goes up, debt goes up, debt cost goes up, and overall the economy, in a way that offtake slows down, consumer also, because this is how the stock market. So the capital cost, what you call it, the that PE, or the reverse of PE, we call it that capitalized rate. That is how what is PE? PE is actually that capitalized rate. Or if you take the reverse of PE, that is E by P, is what what do you call the cost of the capital, which comes out to be at which the investors are comfortable. So any market or any stock market or any stock, which is, when we say that PE is say 20 or PE say 15, so if you take the reverse of that, so it will be, say, suppose 8%. So 8% is the, if suppose the reverse of 15 is what do you call inverse of 15, sorry, not reverse of 15, but it's called inverse of 15, is called 6.66%. So that is the rate of capitalization. Okay, so that is the capitalized rate which you are comfortable at. So as the interest rate goes up, so the PE comes down, right? Because if PE comes down, so that is how the interest rate goes up. So the PE will definitely come down because of the capitalization cost, what you call, it will definitely come down. So market is anyway going to go down. Right, that is the first point, first reason. And if RBI, Reserve Bank of India, doesn't increase the interest rates, only of that 40 bips which they recently, 2 weeks before, I think they increased, unexpected increase to tackle this inflation, increasing inflation, then what will happen, as I keep on telling in so many, 6 months I am telling in most of my videos, that you will see that rupee loses its value. See, devaluation happens, right? So the cost of purchasing power, disposable income goes down because the real value of rupee goes down. So rupee will go down against US dollar, as I have come out in recent video also, that it will touch 80.6. So that will be the second point, that if RBI doesn't increase the interest rates to tackle this increasing inflation, then rupee will come down. Rupee will keep on declining. Okay, this is an automatic way of, you hold the hand, ears like this way, or you hold ears like this way. It will happen. So if it comes down, rupee, so also it, in dollar terms, it becomes loss for the foreign investors, or the that investors who are not domestic investors, who come from outside. So there will be a faster selling by these FIIs or the whatever the funds or the investors who are coming from outside India, and selling will increase into the Indian market. So by these 2 points, either if you try to say that government says that you support growth and don't increase the interest rates, then what will happen, that rupee will decline because it's an automatic adjustment. Rupee will decline, so the power of purchasing power declines, so the consumer and all these things, stocks will, so the growth will suffer. And also because of the rupee decline against USD, the selling will happen fast by the foreign FIIs into the market, because for them, when they take the money and they go out, so when the conversion happens, they lose because of the less rupee, right? So if it keeps on declining, they will not put the money, they will take out the money because it makes sense for them to book profits. So selling will increase. That's what it happens. And if they increase the interest rates, as I told you, they will have to. So here comes my 2 cents of advice, is that RBI will have to increase interest rate by minimum of 179 bips. Okay, they have already, that repo rate they have increased by 40 bips. So another around 149 bips increase has to come to give support to the rupee and also to stabilize the economy. Okay, over a long term. Okay, growth may suffer. It may look like that growth may come down, but growth may anyway come down. Even if you don't increase interest rates, growth will come down because of the high commodity prices and inflation and selling by FIIs and money going out of India. So growth will anyway come down. But what will happen is that inflation will continue to remain very high, and a poor country like us will suffer heavily, because if the purchasing power comes down, government will also suffer, and this will be an overall instability of the economy, and it may decline even much faster than what if the RBI doesn't increase rate. So it's a devil and a deep sea situation. So these 2 points, as I told you, this is what I just wanted to explain, that whatever happens, the Indian stock market, or what you call that Nifty 50 or that Sensex or the Indian stock market, is going to be in a deep gorge kind of a situation, deep sleep situation, where it's not going to go up in hurry. In fact, it will remain in this kind of a down situation with a negative bias only. So better to avoid. That is what I just wanted to discuss my this point also, that this is what we are going to see the situation in the next few months, what happening to the stock market, and wait for the, and at least if the RBI increases that CRR or whatever, a repo also, so at least that way that bank deposit rate will also go up, and that way the real value, or you will start, depositors will start earning some real, otherwise it's a negative interest they earn, because inflation is higher than the bank deposit rates or the fixed deposit rates or the bank interest which they give on the deposits. So that is why also they should increase, and once they increase, this is what going to happen, as I expect. That's it from my side, and till again, if we find till next week, till some new scenario, new unique idea, new unique concept, which if I find, I will discuss it with you. Any update till that time. Ciao from Neeraj from Moscow, and love you all.